Alex, thank you very much for joining me. It's great to have you here.
Absolutely. Thanks for having me on. I'm excited for this.
Likewise, really excited. I've known Julie for a while. This is the first time we're talking, but I'm really excited about what you guys are doing. So to start off, could you give a quick intro to you and Chaos Capital and what you do?
Yeah. So I'm Alex Miller. I've been in the startup world for the last, roughly 20 years, let's call it, pretty much ever since I graduated college. I actually originally weirdly got into startups. I used to be an event producer. I was like a concert producer for big shows and stuff. And I went to work for world famous first angel investor in Uber, Jason Calacanis, as a as a conference producer and things. And so I produced like TechCrunch50, launched This Week in Startups, and that gave me like my real first actual like day-to-day working in startups and exposure outside of like, little projects and businesses and things I started like as a teenager. And, kind of thrust me right into the deep end on it. So went from working for him to Yext, spent 8.5 years at StackOverflow and kind of built out the whole private Q&A business there. Been a number of other, kind of advisor and things to developer tools companies. And then currently run labs company and developer tools company for on top of Bitcoin. And so, through that whole time too, kind of went through, I think, what was like the traditional journey that a lot of tech people go through of, starting to put a little bit of money into your friends' companies. You first do it when you are being a little creative about whether you meet the accredited investor threshold, and then you actually meet it. Back in 2021, Julie and I were sitting around and talking about like whether we wanted to kind of bump up the angel investing to the next level, right? And actually start doing some kind of a fund structure of things. And we were sitting around talking, and she, kind of ever being the futurist, started talking about what became the thesis for chaotic capital. I think this is something that had been brewing in her mind for a while and ties back to a lot of the stuff that she'd always been thinking about. But it really goes to this idea that, look, the world is getting increasingly chaotic, right? You can't predict stuff well. Humans in particular are really, really bad at predicting the second, let alone the third or fourth order effects of changes, right? And because of that, you can't predict the future. You can't actually try and control the future, right? The tighter you grip it, the more it slips through your fingers. The only thing you can do is be more adaptable. And I think that's a big lesson of anyone who's worked in startups and early stage stuff, right? And you hear most investors talk about this, at least in an abstract way, right? When they talk about in the earliest days of investing, you're not really investing in the company, right? You are investing in the founder themselves because they're going to figure it out. And that's because, without a doubt, when you're dealing with early stage companies and things, the adaptability of the founder, the ability of them to be focused on the end goal, but a change with whatever is required, is absolutely the most important thing, far and away, no question. The only thing that's really different in how we think about it, I think, is number one, we don't just want the founder to be adaptable. It's that we want adaptable founders who are building adaptable companies that make people, society, or companies more adaptable. So it can be a very wide range of things. We're completely sector agnostic on it. We've got everything from crypto to AI to biotech to energy, all kinds of things. And the way we try and do it, right? This was the other kind of big thing, is we are true like inception investors. Our best investments, ironically, have literally come from when we met the founder before there was even a company, right? Maybe they were working on a previous company. They had ideas, we were talking to them, because the thing that we really want to see, going back to that idea of adaptability, is how do they actually integrate information? How do they take in those new things, counter their existing beliefs, think through it, try something new with it, invalidate their ideas and move on. And in our ideal case, if we can get a month or two working with that, watching them go through a product development cycle, like there is more signal in that than in anything else that you could ever do. And so that's kind of our goal. Just meet them as early as possible, which we do mainly by Julie being weird on the internet. We say same way you met her. Just like go on Twitter, find her, come across her, start DMing with her, and you'll like become friends and she'll do it. And that's where really like all of our, kind of most of our investments, almost all of our investments came from there. Some also come through, friends who are angel investors or things and would kick things over to us. But like the majority of our best investments have been people who just like cold DM'd her on Twitter and were really able to carry on the conversation, which I think actually hits on another really important part. We don't really do a lot of live calls with founders and things. It's almost all like asynchronous on Twitter DMs and Signal for that initial getting to know you, if you cannot communicate effectively through that medium, not going to make it. If you cannot communicate effectively asynchronously and be like direct and clear and well written in your communication, and even understand how to structure and run a conversation in that format, that is how so much of communication is happening these days, especially if you're trying to get access to higher level people who are busy, who have constant stimulus on them. If you can't do that, you're going to have a big, big problem.
Getting back to the thesis a little bit, because that's fascinating. I guess if you reduce venture capital firms to two camps, one which are like, we have a thesis, these are the categories we focus on, this is what we invest in. And then the other, which is, I think, probably like a more purist generalist view of, we don't know what the world's going to look like, but we have money available for founders who think they can figure that out. I guess you're the latter, right?
Yes, I think we know some of the attributes or characteristics that the world is going to have and that we think are important to exist in the world. Mm-hmm. But exactly what it's going to look like, people don't know. And this is also obviously a big difference between when you're doing very early stage versus mid versus growth stage. Once you're at a growth stage on a company, or even a little bit later, like you can see the contours of what the company is going to be. But in the earliest days, like when you're first time out, there's just a founder, they've got an idea. You have no idea if it's going to work or not. Absolutely not. And it really does come back to, in fact, the only thing you do know is that the first idea is going to be wrong. I don't know that there's ever been a single company where the founder had the exact perfect idea, they knew it exactly, and it became exactly that, which is why even if you like the idea, you want to validate the business, sure, do all those things. But if the person can't adapt to the insanity of early stage and the amount of information that's going to get thrown at them, and most importantly, has a low enough ego to be able to constantly be proven wrong by the world. This was actually one thing that when we were getting into it, I didn't realize as much, but we've seen it come up time and time again. Our best founders have no ego about being wrong. And you have to, because you're just going to get battered by the world. And if you are holding on to these, I don't want to admit I was wrong at that. Again, you've heard other investors say these things as like, right, strong beliefs, weakly held, and that kind of thing. But to me, I don't think that captures it quite right, because I think when you hear people talking about that, you're talking about a very data-driven structural thing of, I'm going to make a hypothesis, and yes, that's important. But again, what we've seen from some of our founders is they realize that they've gotten 6 weeks into a fundraising cycle and they've been making completely the wrong pitch. And they've had the door closed on them 30 or 40 times, including from some of their top prospects. What do you do then? Mm-hmm. Do you keep pressing forward with what you're doing? Or are you able to say like, hey, I made the wrong pitch, right? I need to change this. I need to redo how I'm approaching this. And I might have to accept a lower valuation on this round, which means giving up more dilution. I'm not own less of the company because I made that mistake. That's a brutal thing to have to do as a founder or as an executive of a company. And the ones who are going to make it are the ones who can who can internalize that really quickly and really accept it and just move on and get done what needs to be done.
Yeah, I can't resist like dropping in a little bit of data, some of the stuff that I like to share and write about. There's two awesome reports on exactly this. So one is a Startup Genome report on premature scaling. Looks at companies that raise too much money too soon and how that's linked to a surprisingly high rate of failure because they end up over-investing in growth on an idea that is not ready. So that's one. Another one is a really interesting report on pivots. And it's looking at like real, like fundamental pivots in the business. And I believe they came to the conclusion that high-tech companies were actually more likely to grow faster or to find success faster after one pivot. So like the initial idea most of the time is probably wrong, exactly as you're saying. But we have this habit of like hindsight bias.
Right. You're making a guess, which is good. That you want someone who gets in there and makes the guess. But no good plan survives contact with the enemy. No good business idea survives contact with the real world and real customers. Yep. But that's because the data in that is incredibly valuable.
There's another interesting thing. I was listening to a very old, I think it was like a 2016 talk by Cyan Bannister. I think it was at the Angel Launch Summit back then, and she was talking about her relationship with Scott, the way the two of them work as a partnership, and they're very complementary because they each like doing very different things. Obviously, I think in a kind of similar way, she's a bit like Julie in that she's the one going to events and meeting founders, and perhaps you're like similar to Scott in this example as well. But I'm curious, like, how do you guys break up responsibilities? Like, how do you divide and conquer?
Yeah. So actually, it's the inverse on that one. I am the
Okay.
in-person person. Julie is will mostly talk to people online when doing it. And I think actually, especially for meeting founders, she would much rather, I think a lot of times, meet them async, because you're not going to write a check based on like on a 20-minute meeting at a conference or something anyways. We really want to see them over time. So yeah, definitely I'm the kind of like out in the world person. She's more of the online person for it. But at the same time, yeah, everything else, it's all very complementary. Like she's the investor, she's the futurist, I'm the operator, the tangible person one. She can read people and I think, makes really incredible calls on who's got the capabilities of founder. I'm the one who like knows how to build a model and do that. But also, and it even breaks down to like she's the pre-investment person. She's going to largely make the call of like what's a good investment to make. She's really amazing at emotional support and stuff for founders afterwards. But that's again, especially where like I'll step in and helping them both on kind of the what it takes emotionally to help a founder through, but also the like tangibles of, okay, how do we actually like literally get you a lawyer that's going to work, right? How do we deal with this co-founder dispute that's come up? How do we, whatever the like miscellaneous operational issue that come up is. So yes, I think we both have a lot of overlap in view of the world and what's important. And that's like kind of the unifying element to it.
Mm-hmm.
But very different skill sets, very different ways that our brains work, very different ways that we even just kind of communicate and think through problems.
And is that reflected also on like the LP side, the fund side? Like one of you deals with LPs and the other one like doesn't touch that, or?
Yes and no. I'd say actually the same kind of basis that you're seeing mirroring there comes up there. I think ultimately LPs, I think, want to understand the fund, right? The same way that, investors want to understand like the company and see it. And that, for the most part, they're not going to write a check. You as an investor aren't going to write a check into a company where you've only met one of the co-founders. I think it's very true often with LPs as well. Like they want to know the partnership. They want to see who's there. So those ones will tend to be, I'll run the process around fundraising much more, which again, just aligns with kind of that operational approach. But I think a lot of the ways, especially for LPs who are less institutional allocators, but like really want to align to the vision and stuff, there's no kind of substitute from hearing it for her mouth.
Interesting. Yeah. And talking about the fund side of things, I believe you have more of a mix than a typical firm in terms of like what you invest through a traditional fund versus like maybe doing more SPVs than normal. Could you talk to your thinking about that?
Yeah. So we've done a mix of things. We've done both SPVs and a rolling fund on Angel List. So again, we kind of started with that traditional, like write a few angel checks and things like that. And then when we started thinking about doing the fund in particular, we got an opportunity to do an investment into a company called Squads, which is the original kind of multi-sig on Solana and now has a whole stablecoin payments approach. They've done kind of amazing on that. And that was our first foray into SPVs because we didn't have like a fund. We couldn't write as big a check as we would have liked to on it. And we just kind of jumped right in. We're like, okay, let's just like see if we can raise this SPV thing, which we did. And yeah, that was great. And that I think also kind of gave us the confidence to be like, okay, we could go do this. But also it's like, SPVs have a lot of advantages and a lot of disadvantages to them. Obviously, the biggest problem is you can't just commit to a round with an SPV. You can say, well, I think that I can raise this much to it, right? So it kind of became clear to us we wanted the ability to actually commit to founders and like say, boom, we're in for this much. We know we can do it. We have the money. And so it was after that we decided to go and raise a rolling fund, which we did, and then started writing checks out of that, and then still kind of held back the ability to, for later rounds in particular, do SPVs. So, our goal there is like, we'll do kind of the inception / pre-seed, as well as the seed out of the fund directly. And then for anything later than that, and actually in one case too, we even did we both did a direct seed check out of the fund and then also an SPV for the seed. And then, also seeds for anything like Series A or special opportunity there. And I think when you're getting started, that's a pretty good balance, I think, from it. When we've talked about like larger fund strategies and things, okay, maybe you can extend fund checks all the way out through the Series A on it as well. But if you can build up a good LP base, or especially connections to people who also have it, the SPV structure can be a really good way to get going, because it's so much lighter of a commitment for both you and the organizational structure you have to have around it, but also for the LPs. It's a lot easier in many ways to get people to commit to one deal than to just entrust you with like tens of thousands of dollars, hundreds of thousands of dollars of their own money in it.
For sure. Yeah, absolutely. There's been an interesting theme with everyone I've spoken to so far of they all went into raising their first fund or beginning to invest thinking like that LPs were all kind of similar. And they've all like over time realized that like actually no, LPs all have like very different interests, very different priorities. And that obviously impacts like the kind of funds they're willing to invest in and so on. It's like, is there a particular like commonality between the LPs you work with, or some kind of theme you think that makes your strategy work?
We're definitely like weird high net worth individuals.
Okay.
It's a lot of tech entrepreneurs and folks adjacent to it, and not a lot of like large, old family office stuff, or like we're not going to endowments. Obviously, they also want to just be deploying like $100 million a check, and we're just not at that size on it. I think you're very correct that the number of types of LPs that are out there, it's the same thing as someone who tells you like, we sell to businesses. Okay. What does that mean? There's a lot of businesses. You could even say we sell to, large enterprise businesses. Okay, great. There's a lot of very specific large enterprise businesses. And I think making a sale for fundraising is no different than making a sale for anything else. Like, you have to come up with an ideal customer profile. And you need to really understand the differentiations and what's you build up a qualification pipeline the exact same. You really have to understand, what are these people looking for? What is it that they want? What is it that's going to scare them? And figure out who's going to be a fit for you and who's not.
And I guess naturally, because of the kinds of people you work with, they're also way more tolerant of you investing in companies like doing nuclear power, where there's, unknown capital needs in the future, unknown horizons for when that might exit or whatever the future may hold. But like, I can see a lot of LPs might have been a bit concerned about that elsewhere.
Yes and no. I mean, when we raised the fund, we did not know we were going to be writing a check into a nuclear power company. So that's part of it. But I think, we were talking to people who just kind of want to see something a little quirky and interesting in the world, right? Who understood like, yeah, you're making a bet on a founder. Hopefully they do something cool. It's super high risk investing type. It's going to either work really well or not particularly well at all. It's not, it's really hard to predict what the return profile is even going to look like. So it was definitely, and I think that's again why we went mainly with like people who just think there's an interesting future out there, and who maybe, a lot of folks who had talked to Julie online or have been following Julie online on Twitter and liked her view of the world, because again, it really is the exact same way that like we're making a bet on these founders just kind of figure out something that works. When you don't have a particularly long track record in investing and you're trying to get going, people can either bet on like, kind of the market thing, or they can be betting on you. And again, when you're getting started, you kind of need people who are going to bet on you.
Do you think it's a requirement that an LP in a firm like yours be entrepreneurial themselves, like to see the potential in this stuff, or not?
I don't think so. I think they need to like the idea of it and be inspired by it, but we've definitely got folks like in our fund who are not entrepreneurs themselves.
The usual like dentists and so on archetypes.
Yeah, maybe maybe not quite dentists, but don't take money from dentists. But yes, but in that same general realm, like they've been working a 9-to-5 job, or they're a lawyer or something like that. You'll have hints of it. I'd say they're all high agency people.
Yeah.
Right. You'll usually see a crossover between entrepreneurship and agency. So you'll definitely get that. But I think definitely not all like tech titans or tech entrepreneurs.
Yeah, for sure. Makes sense. Well, I want to talk about Valar a little bit, Valar Atomics, because I think Isaiah's amazing, like one of the greatest founders of our time, possibly. Incredible company. Not long ago, became the first nuclear startup to generate electricity, which is like a crazy milestone.
Yep.
What's the backstory of meeting them and getting to know them?
Yeah. So Isaiah is literally like our canonical example of how we want to meet a founder. Doesn't hurt that he's also doing very well. But even before that, he was our canonical example because he DM'd Julie on Twitter cold when he was working on a previous idea. We didn't love the idea he was working on or the people he was working with. It was a couple big law lawyers. And Julie kind of warned him like, hey, these guys are probably not going to work out. And the reason we knew that is we got on the pitch with him and his co-founders. And he was the CTO. And he did the whole pitch. And we're like, that's wrong. A CTO should not be doing the whole pitch for a company. But again, like you could immediately tell how special he was. He was you just got it, right? And so we kind of kept talking to him and we told him like, hey, we don't like this idea. We like you. If you go do something that you really want to be doing, we'll totally back you. And he came back to us like a month later, again, talking about like how quickly people integrate information and things. And he said, hey, I've got this crazy idea to like make synthetic hydrocarbons using nuclear power and to produce nuclear reactors really cheap. And we're like, cool, that sounds insane. I love it. Like we'll give you a check for it. And we obviously talked to him a couple times. That was pretty much it. It wasn't like we technically vetted the idea or anything. It's that we liked him. It made sense. The way he thought about how to go about it made sense.
Mm-hmm.
And so we burbled in and we're like the first investors to give him a commit and join the round on it. And, I think everything we've seen, the crazy thing is that was barely over 3 years ago. And everything we've seen since then just reinforces that idea, is watching the speed with which he integrates information, the quality of his leadership, how he can get people to buy into his vision and join up and take the chance on him, the relentless focus that he's had. And that thing I said about having no ego about it, being able to take the lessons, even the brutal ones, and do them and move on. And it's just been an incredible journey to watch on it. And another word that, again, we both use, but especially Julie, like, is the idea of like hyperstition, right? And the best founders just have a way of making things happen in the world, right? It's a lot of shots on goals. It's a lot of just, again, being relentless in it. And a lot of it's just having good judgment, right? I think that's one thing that is really hard to quantify sometimes. Some people are just better at intuiting what the right takeaway and the right lessons from something were.
Interesting.
And he's been incredible at that, especially when it comes to like what it means to do manufacturing and what's important. And so being able to integrate all that and just kind of trust it and go in that right direction and pick it up, that's just something that like the best founders in the world are just good at doing. They just kind of have a gut instinct on it. They trust it. Again, they're not going to overcommit into it in some ways. Like they're going to test it. They're going to be methodical about how they go about it, but they just kind of have a gut instinct that they trust and they happen to be right. Mm-hmm. And at the end of the day, it is that kind of thing. And it's the reason you see, I think, a lot of cargo culting sometimes in investing and in entrepreneurship is because people think if they just do those behaviors, it'll work. And that's not how it works, right? It's the part one is you have to be good, right? You have to actually have like that right gut instinct thing. And two, you also have to be lucky somewhat. It has to be that the right things come together at the right times.
Correct me if I'm wrong, but I seem to remember listening to or seeing Isaiah talking about like a family connection, like a grandpa that worked in nuclear or something like that.
Yes.
I think.
So his great grandfather Ward, for whom the Ward 250 reactor
nice.
worked on the Manhattan Project in Tennessee.
Gotcha. Yeah, that makes sense. Because my suspicion was probably this idea was in the back of his mind initially before he approached you with the first idea.
Oh, absolutely. I mean, he'd had this idea since he was like a high school student and was self-teaching, maybe not the detailed nuclear engineering part, but certainly like the conceptual level.
So the thing, like the ingredient he was missing was to have that first conversation with you and to be told like, this idea is not right, but like, by the way, if there's something like in your mind that you might want to do that you really care about, exactly as you said, like come talk to us. So we had that first believer to come
That's
back
exactly
to.
what it is. And you know, I know from talking to him and even talking to his family about it, like that first believer part is big.
Yeah.
Someone telling you, yeah, go for it. Like you can take the chance on this.
Yeah, at the risk of like getting on the soapbox a little bit myself, a real conviction of mine is the venture capital world needs like loads more investors with less capital each probably, but like way more first believers out there all over the place to find people like Isaiah.
Absolutely. No question about it. Though that's that, and that is the difference between like a lot of the US venture capital landscape and the really successful communities in the US versus other places. Is you have all of these angel investors who made some money, who do it. And like, yes, the money is important, but much more than that, it is the signal, it's the expertise, it's the encouragement for people that it is worth going after, that they should give it a try.
Are you worried at all about all the talk about like concentration in venture and the mega funds and so on, or do you feel like that kind of doesn't really touch you?
Yeah, absolutely. I mean, one, it does make life for an emerging manager harder, but it also absolutely leads to more groupthink and concentration and, you know, a loss of the art of, let's call it, of investing and you know, or the witchcraft of it, I think is even almost a better term. Yeah, you end up with more capital kind of being thrown to waste a little bit, and you know, on clones, on things that aren't going to work, just because everyone feels like they have to have a bet in that place.
Yeah.
And look, having multiple companies pursuing something is obviously a good thing. It competition is a really important and good thing, and some level of the concentration. Having these giant funds is a good thing in the sense that if someone has really big capital needs, you can now get billions of dollars to scale a hardware play. Like that is a great thing. That is important. But the more it turns into like a business in some ways, like obviously you want it to make money. It's a capitalistic endeavor. But like one problem in the seed space right now is that you have all of these late stage firms with, you know, 10, 20, 30 billion under management who are willing to write absurd prices into seed rounds, right? 5, 10, 20 million dollars at 50 or $100 million valuations. I'm not even talking about like the, you know, $2 billion for thinking machines or whatever. I'm talking about even just like what, you know, hot seed rounds are in general, because they don't care. It's a loss leader for them, right? Like they're just trying to basically buy access to be able to put $100 million or $1 billion into this company later. So they don't really care about the $5 or $10 million up front, but it does really fuck the economics when it comes to smaller funds and angel investors and things up front. And so you've seen companies even adapt that, where they'll like raise angel round. They'll raise like $1 million in an angel round on, you know, day one of the month at a very reasonable, like $10 or $20 million valuation. And then 3 days later, they'll raise an institutional seed round, $5 or $10 million at like a 60 million. Or whatever, right? Because like they know that it's not fair to like the angels to do it, but it really does end up shutting out a lot of like the younger emerging managers, folks who that. And then they're getting squeezed doubly on the LP side too, where the LPs are just like, I just, you know, have so much capital I want to deploy, or I want to shove it into these big, large names out there. And then the third leg of that is there's just less, again, unique LP capital out there because of sort of the delays in returns there. So I know, you know, a lot of folks kind of holding out hope that with SpaceX finally hitting the IPO market, other folks hopefully doing it well, that it opens that up. But we absolutely, as we've gone through, you know, the number of people we talked to who were just like, hey, I'd love to, but I'm, you know, 2x over allocated to venture right now because all of the valuations have gone up so much and nothing has exited. It really ends up squeezing and creating that more and more of that concentration that you're talking about.
Yeah, and the cynic in me wonders, going back to the point about like overcapitalization and the threat that has to companies, if the big firms are like kind of okay with that, like either it's a rocket ship or it explodes, and like that's a fine compromise for them, even though there's this whole middle ground where like the company could find its way and do something really interesting, which we never get to see. But like, you know, it keeps things simple.
Venture is a power law return industry. So yes, I blame founders least of all, usually when they overspend, because their entire incentive structure is telling them to. The entire culture around it is telling them to, because in the, 1 out of 5 or 1 out of 10 times where that is the right call, you have to do it. And it's an incredibly good decision and it returns 100x. So yeah, if you can have 5 or 10 companies go to 0, but one go to 100, that's a pretty good return for the investor and the incentive side.
Yeah, in theory, but like TBD how this all actually plays out.
Yes, in theory.
Yeah. Going back to Valar for a second, what was it like? Like, obviously you did the first round. Then I presume there were subsequent rounds when the company needed money but wasn't yet hot, like pre-consensus, whatever you want to call it. What was the process of like helping them raise downstream capital like?
Brutal. Yeah, the first 2 rounds were the 2 hardest, without a doubt. And I think that can often be obviously the case for a company. Also, some companies hit problems later on. Fingers crossed that was the last hard round they'll ever have.
Mm-hmm.
Again, I think when you're a really early stage investor, there's only 2 things you can do about it at that point. Number 1 is obviously connections to other potential investors and, calling folks, trying to get them interested in. And 2 is just supporting the founder, making sure that, they know you're there for them in it. Like in our case, we absolutely wrote, as soon as was needing it, wrote in a second check out of the fund into the bridge round. That check will end up being worth, be a very good decision in it all. So would have done it regardless though, right? It was like the right thing to do in that situation. Because again, just like they need help getting out the gate on the first one, supporting through those times is one of the most important things investors can do. And frankly, if you can't, then just be upfront about it to the founder. Even that is a gift to them in it. There's way, way too many investors out there who kind of will string along and wait and, want to be half in, half out. Like, no, if you're going to do early stage investing, like part of that is you just got to be actually with them in it and be frank and direct and real. And like either you can put up or you can't, but don't string them along. Don't drag them out like that. So absolutely. First couple rounds, again, back before there was kind of like the market dynamic shift on it, before we really had the story nailed down and everything, were absolute brutal rounds. And, there's always all kinds of stories, later things too. There's a million points in a company's history where things feel unsure and feel like, you're moments away from death. One of my favorite old phrases, right, is that like the emotional journey of being a founder is like waking up in the morning, Googling about food stamps, having one amazing call and then Googling for private jets, right? It's just the roller coaster of it's absolutely insane. So yeah, the plenty of ups and downs on the company for it. And now, of course, now you're at a point where it's like this exciting company. They're clearly running faster and executing better than anyone else. And so now I will just get calls in the middle of the day from someone being like, can you get me into the next round with them, right? Can you introduce me to the company to do it? And I'm like, the time to call me on this was like a year or 2 ago, right? Like that's when they needed it. Now that it's an obvious and like a consensus thing, like, yeah, of course you want in. But guess what? So does like all of the biggest funds in the world. So what's the thing that you're bringing there? And like, that's why, if you want to do these kinds of things, you really do have to be, oh God. So literally one of our favorite movies, obviously, was some of the best scenes ever, Margin Call. I assume anyone watching this has seen Margin Call on multiple occasions, right?
Yeah.
You can be smarter, you can cheat, or you can be first.
Yeah.
Right.
And it sure is a lot easier.
Those are the only 3 ways to make money in business, right? And it's like, do you think you're smarter? Maybe, probably, I don't know. I definitely don't cheat. And so being first and being willing to take that chance, like that is kind of the only way if you're not going to have some giant brand where you can leverage it. Because look, that is the advantage to some of these later stage firms or, someone as big as like, yes, they bring credibility. They bring the ability to bring not just massive amounts of money and capital out of their fund, but out of, other folks that they're close to and things. So if you're not going to be able to move that, then the thing you have to do is you just have to be able to get the conviction to write before someone else.
I think there's like a weird cognitive dissonance or like confusion in venture where people know like competition is good, markets are good. It's good for venture firms to be competitive and LP should want that too. But the way that competition manifests is firms competing for access to deals and not firms competing to deliver the best results, which is what it should be. So you see like this competition for access and for hot deals and talking up like the potential for these generational companies, which, are predicted to be winners, but like, who knows? There's a quote I love from Tim Draper. He's talking about like what to do if you find yourself in a position where you're a VC firm and you're bidding against another for a deal. And he said, like, just don't do it. Like, they already have a check. They don't need you. Go find someone else who needs you. And I think that's a great way of looking at venture.
I absolutely.
It goes back to the idea of like needing a million people like you and Julie in the world to fund founders.
Right. And that's exactly why you need that. And the other advantage of having a lot of different check writers is it increases the confidence of people that they can get follow-up money.
Mm-hmm.
Right. It was absolutely, I'd say, a concern, not enough to make us obviously not invest in Valar right off. But we did have the question of, okay, how are you going to raise like $1 billion for this? And again, Isaiah was clear from the front he was going to need to raise $1 billion for it. Mm-hmm. That's just what you kind of have to do. Unfortunately, there were a couple SMR companies out there that had already, raised like 9 figures worth of capital. So it was clear there was at least some appetite for this out there. But yeah, that is one other challenge with concentration is that, okay, it's great that one fund can write so much, but you also need to know that there's enough competition that people will take the chance on things and do the follow-up capital writing. Now, again, that's part of the reason that I think people will take the cop out of like, oh, I would have done that deal, but I thought there wouldn't be, that excuse gets used for a lot of things. Like, again, that is one of the things you can do as an early investor is write the check yourself and then help them go get the rest of the damn money.
Yeah. Yeah. And I think like traditionally this has been a little bit lost in all the mess of like platform teams and like media and helping founders win the internet for the day or whatever. But like traditional role of a VC was 2 things. It was monitoring, so making sure they're like not doing something super sketchy that'll get them in trouble or whatever. And it was capital formation, helping them raise the money they need. So even once it grows beyond the capability of a small early fund, you can help them form that downstream capital as well.
That is the job.
But the monitoring's been lost, I think, because it's seen as not founder friendly, and the like forming capital has been lost because venture is less collaborative than it used to be. I think, right?
The cynical part of me would say that part of the reason that monitoring, I'd say, has gone out of vogue is partly it's the not founder friendly thing, sure, but I think it's that most people just don't believe it matters that much. And this goes back to the power law distribution thing, right? If you're really tight and holding on and gripping it, it's not, are you going to catch something wrong? It's, are you going to catch something wrong that if you fix becomes right? Right? Because if you have a false positive on it and you shut something down that could have made it big, you just lost an insane amount of money, right?
Sure.
But if you catch something that's wrong, the company's still probably going to zero. So what do you care, right? Like the odds that you caught something wrong and now the company became successful because you caught it, what do you care? Again, you're already expecting 80 or 90% of your companies to go to zero anyways. So like, what's the difference? Again, very cynical view. I don't think that people are doing that super explicitly. But even on top of that too, right? Especially, there's also just a diffusion of responsibility when it comes to investor, right? Especially on a hot company now, they've got 30 or 40 different people and funds on the cap table, and 1 or 2 of those are going to have a board seat. And each of those people also has a few dozen other investments. Like there's just asymmetric time investment and context and knowledge investment on it. So yeah, the monitoring thing's not really there, and it leaves it as, the one thing you really can do is capital formation.
Yeah, which gets more and more important, especially as
absolutely
companies get bigger and more ambitious. They're going to need a lot of money.
Yep.
We have a few like regular questions that we ask. The first one is there like another investor, another manager out there you think is doing a great job, who like you think is worth like a shout out for what they're doing?
Oh, I think there's a bunch there. I think, all right, the one that always comes to mind, and I know I'm also thinking because he had a good day-to-day with one of his companies getting a huge contract, is Ian at Canto. So I think, one of the OG
legend
investors, obviously Cyan. So Cyan Bannister's old friend of ours, I think, is finally getting like the true recognition she deserves for being one of like literally probably the best angel investor ever born. Like beyond good and also just an incredible human being. Root Ventures team, also like kind of love their whole team and like started kind of betting on this and growing their fund early on. And then like the Bold Start Ventures team, who again, like someone else who grew themselves from $1.5 million like initial seed fund the first time out to like $1 billion plus under management now. And like they've done that by just being like amazing guys to work with, as well as being like really good at what they do. So I don't know. I just named several, but yeah, I love like all those guys.
Those are all fantastic picks. Like zero argument for me. Cyan obviously is like on level of her own, I think.
Yeah.
Next question is, if there was a piece of advice, something you know today that you wish you knew when you started, what would it be?
For any particular person or like category of people?
If you were starting Chaotic Capital today, like brand new, and there was something you know now that you wish you knew when you started.
GP relationship. If you want to raise a fund, GP relationships, like your relationships with other general partners, other people who run funds, are critical, because like you want into deals, you need to pull them into deals, and you need LP introductions from them, and then you just need someone to commiserate with, right? There's a reason founders become friends like with other founders and things too. So absolutely, if you're just getting started, like working on your GP relationships, hugely important.
And is that just a matter of like shooting them DMs, like starting the chat?
This is what's great about Twitter, right? People like just reply to DMs on Twitter.
Yeah.
Twitter events, wherever. I mean, it doesn't matter. However you meet people and want to network with them, but like get to know other people who run funds, both kind of at like your stage and area, as well as like a little bit after you.
Mm-hmm. Perfect. And the last question, well, second to last question, I should say, is if the kind of general thesis of Chaotic Capital is correct, like if the world goes in the direction you think it's going to go, do you have like a picture of what it might look like in 10 years from now?
No, don't. I mean, because I think the thing is like, it's, we don't have an apocalyptic view of the future or anything. It's that it's really hard to tell what it will look like. Even if you're good at predicting some of like the specific events that might happen, again, what the second or third order events of those changes might be, really, really hard to predict, especially over time and things. So, I don't know. It's just be ready for kind of whatever happens.
Yeah, that's kind of a funny question to ask you, given your thesis is basically like the future is so unpredictable.
Yeah, exactly. And it's funny, like we live on 5 acres outside Bozeman, Montana, house that can kind of go completely off grid. Not because I expect to like survive an apocalypse or anything. I have no interest in surviving an apocalypse or anything, but just because like it's quieter and it's smoother. And you know what? If there's a giant disruption, it's going to hit me a little bit less because of it and because I'm prepared for it. But I don't think I know what that's going to look like.
The last question is, and I think I know the answer to this one already. I think it's going to be a DM on X, but if someone wants to get in touch with you, like what's the best place?
Yeah, definitely a DM on X to me at Alex L. Miller or to Julie at Almost Media.
All right, perfect. Alex, thank you so much. It's been a pleasure. Like I said at the beginning, I love what you guys are doing. I'm personally a supporter of you and like most of your portfolio companies. So I appreciate you taking the time.
Absolutely. Thanks so much for having me on.